every time you come on, we talk about Brexit, and then we talk about the periphery countries and the spread between Italian bonds and German bonds. Will it get easier, or do you see Brussels and Italy kind of, fighting again?
Well, look, I actually think there's a pretty interesting linkage between these stories, because if we think about our outlook for next year, and we are out today with Morgan Stanley's 2019 outlook, right? The big story of 2018 was the U.S. outperforming the rest of the world. And I think next year it might be the opposite. The rest of the world is going to look better relative to the U.S. And I think that could even apply to Europe, right? There's a lot of uncertainty here in Westminster. There's a lot of uncertainty in Italy. But the good news is that markets are already quite concerned about these issues. I think expectations are quite low. And I think if we look at a situation like Italy, but I think this also applies some to the UK, there is a back and forth between markets. As markets apply more pressure, politicians adjust their stance, and vice versa. So, look, I think, next year there should continue to be volatility in BTP spreads. Our base case is that they're somewhat wider from current levels, but we don't think that they prevent the European economy from growing at trend. We think the euro ends next year higher.
Okay, but so how concerned are you on the U.S.? That's the flip side.
Yeah.
And if the U.S. slows down significantly, is that it for Fed hikes? And what does it mean for emerging markets?
Yeah, so look, I think that could be a market that really surprises people. We have U.S. growth decelerating to just a 1% growth rate in the third quarter of next year. And we think that after the Fed hikes in March and June, kind of trying to stay on track, but when it's confronted with that type of deceleration, has to pause after June and only gets in 2 hikes next year. So I think that has a number of important effects on markets. I think that should weaken the dollar. That should drive some convergence in U.S. and European yields. And I think if you have a weaker dollar and, U.S. 10-year yields that are at current levels or lower, I think that's actually quite supportive for EM. So in a big change, last year we were underweight emerging market equities. This year we're changing that. We're moving overweight EM equities. We think it's going to be a much better relative performance backdrop for EM assets.
How worried should we be about U.S. growth? I mean, are we talking like a slowdown or actual recession? And that's probably your boldest call, right, in the 2019 outlook.
Yeah, so look, I think the odds of recession, our economists put it about 1 in 5 for next year, but I still think that's probably higher than where the market has it. Again, I think the base case, I think what investors should think about, it's more about a slowdown. And I think it's about also just the rates of change are going to look very tough, right? This is a market in the U.S. that had an enormous amount of adrenaline shot into it by fiscal stimulus. And next year, that kind of pulls back. And so you're going to see quite sharp levels of deceleration. A great example, earnings growth for the S&P 500, right? Currently running at about 25% year over year. We think slows to just 4% next year, right? So it's still positive, but a really large deceleration.